For a long time, silver was treated as a secondary metal. Useful, volatile, but not strategic. It followed gold. It reacted to crises. And when things calmed down, it faded back into the background. That framework no longer fits. For nearly 2 centuries, silver sat outside official monetary policy. Central banks abandoned it in the 19th century. Gold remained money. Silver became industrial. Important, but not sovereign. That distinction has started to break. Russia's decision to add silver to its strategic reserves is not about price movement. It's about recognition. Recognition that silver is no longer just an input for factories, but a material that sits at the intersection of finance, energy, and national security. Russia isn't acting in isolation. China has been absorbing silver for years, not through announcements, but through consumption. Solar panels, electric vehicles, data infrastructure, and electronics all depend on silver's unique properties. China produces silver, but nowhere near enough to meet its own needs. The difference is filled through imports, and that gap keeps widening. This matters because silver supply does not respond quickly. Most silver is produced as a byproduct of other metals. If copper and zinc mining doesn't expand, silver production doesn't either. Primary silver mines are declining. High-grade deposits were exhausted long ago. Recycling helps, but much of the silver used today is locked away for decades in solar panels and electronics. At the same time, demand keeps setting records. For several consecutive years, the world has consumed more silver than it produced. The shortfall has been covered by inventories built up over decades. Those inventories are now shrinking. COMEX and London Vault data show the same pattern. Less registered metal, less freely available supply, more silver tied up in long-term holdings. The market still functions, but the margin for error is thinner than it appears. This is the environment in which sovereign buyers move. Russia learned in 2022 that paper reserves can be frozen. Physical metal in domestic vaults cannot. Silver, like gold, exists outside financial systems that can be weaponized. Accumulating it reduces exposure to sanctions and supply disruptions. China approaches the same reality differently. It doesn't announce accumulation. Its industrial scale forces it. When consumption consistently exceeds production, securing supply becomes a necessity, not a choice. Gold provides the blueprint. When central banks began buying aggressively, prices followed. Not because of speculation, but because steady demand removes supply from circulation. Silver's market is much smaller, which makes it more sensitive to structural shifts. This isn't about predicting exact price targets. It's about direction. When demand grows structurally, supply responds slowly, and inventories decline, price becomes the adjustment mechanism, sometimes gradually, sometimes suddenly. Silver holds a rare position. It functions as a monetary hedge when trust in currency weakens, and as a critical industrial input when technology expands. That dual role creates pressure that sentiment alone cannot release. The market can ignore this imbalance for a while. It often does. But history shows that when physical shortages become undeniable, repricing is not polite. It's abrupt. This moment isn't driven by hype or retail speculation. It's driven by policy, industrial mandates, and long-term positioning by entities that don't trade headlines. Silver isn't just following gold anymore. It's responding to a world that needs more of it than it can easily produce. And that kind of shift doesn't announce itself loudly. It reveals itself quietly. And then all at once. This is legacy of money, where history explains what prices haven't yet.